Edutrainment Workshops, the insurance industry's leading education and training platform, presents Life Insurance, the entry-level series, the products, the underwriting, and the planning applications to position your practice as the premier provider of insurance products in your community. Get on board, get on track, get to where you're going. And now, your Edutrainer, national insurance columnist, Steve Savant.
Well, welcome everyone. I'm Steve Savant, your Edutrainer and coach for our Edutrainment workshops and our introduction into annuities. And I want to welcome you if you're coming into our world for the first time. We're doing basic ideas, and all this week we're doing annuity income. And I might have to throw in a little bit of a mech thing on this. I'll see if we have time later on this week. If you're just coming into our class, we ask you to go back out and make sure that you start at the beginning. Our tutorials are built on chronology, so you have to do it in sequence. So I just highly recommend that you go out to our day one and go through the entire course in sequence. It'll really help your learning experience. And if you say, Steve, I don't know where to get this, I got this off the web by somebody posting it. Great. Just hop out to our site at www.brokersalliance.com. As soon as you come to our homepage, hit that red button, on demand video button. It'll bring you right into all our Edutrainment videos, as well as our daily internet talk show, The Business Insurance Zone, and my weekend opinion piece, Welcome to the Weekend with Steve Savant. Well, let's talk about it today. Today I'm going to be on the whiteboard. I haven't been on that for a couple weeks, and I kind of want to draw out, because sometimes visually it's better than just speaking about it and pontificating in a monologue. So let's just go out to that right now, and I want to show you that. We'll go to the Mondo board right now. Okay, welcome back. We're over here on the Mondo board now, and I want to be able to talk about a few things. Remember, a lot of the things we're going to talk about, I want to make sure that I include phrases that will be maybe unfamiliar with you, so that you can understand that there are some options. And in this course, we're only doing the basic options, nothing really too sophisticated. Now, I just want to show you why this makes a difference. Why did I bring up all the mortality issues, life expectancy yesterday? Because that's how I'm going to be able to measure whether these deals are a good deal or not. For today's workshop, I'm going to be using single premium immediate annuities and SPDA time certain events, 10 years, 20 years certain, just to kind of bring up my point. Now, as an example of this, let's just go to the board, and let's say we have a male, and that male is 60 years old. Now, for our purposes, I went out and I said, I need to see what the actual lifetime income is for a 60-year-old non-smoker. Remember, we're not really going to quantify the medical for right now, but we could do that if we really wanted to get into it. I'm looking at a 60-year-old who puts in $100,000, and I want to know what kind of income can I get. And if I generate it on a monthly basis, although I'm going to go ahead and tally it as an annual payment, that 60-year-old is going to get $56.32. Now, if I use the standard CSO, the 2001 CSO, his expectation is about 81 years. So his total number is going to be north of $118,000. I have to look at that and say, is that a good deal? And I can go ahead and use my patented calculator to figure out if I like that based on his standard tables. Now, if I go and move that up a whole 10 years to age 70 with the same contribution, my number turns out to be a little higher, of course, 72.51, but my life expectancy is a little short, so my total actual income off that is only going to be north of $101,000. So I have to look at, is standard and male a good deal in this? Could I do better maybe using an indexed income versus an SPIA life payment? And if I use age 80, using the same $100,000, my actual number then turns out to be only about $10,000, $10,473, but my total accumulation only gets to $83,000 during his life expectancy. So it really makes a difference to map this out. Now, in contrast, what happens if my client is actually preferred or higher? And I'm not going to measure preferred, preferred plus, and super preferred. I'm just going to go ahead and say, based on what I just said, I just want to be able to start over. And now let's look at it if he was preferred. The same numbers, 60, 100,000, age 60, 100,000, but I'm using the preferred category this time to map out my life expectancy. My preferred, I'm getting the same, 56.32, but because I'm living longer, my number now is 168K north of that number. That's when I start to look at things like this and say, wow, that does make a difference. And I use the same numbers again at 72.51 Same number as we did before, but he's living longer, and that's north of 145K. Do you see what I'm saying? It really makes a difference. Now remember, he could live past these numbers. I'm just doing expectation tables using the 2008 VBT tables, relative risk, and kind of giving an estimate. It's certainly a guess. Actuarial science really isn't a science, but I'm trying to give a good idea of where these numbers are going to lay out. And at age 80, at the same number, I'm going to be looking at the same payout that we had last time for $10,473, but because I'm putting him out to age 90 now, his numbers are going to be north of that number at 104,000K. So I'm going to start measuring everything on my basis of my timeline. I can't just say it's income you cannot live. I don't know if that's going to be good enough based on your life expectancy. What I'd like to do is give some kind of good guesstimation. Now, think about this. That's the male rate. Let's look at the female rate. The rate's going to be lower because the timeline's longer. However, because there's such an extension on the female rate on standard, and especially when we move into preferred plus, and super preferred, that it can really make a huge difference. So let's look at our female rate for a second. If we take our female rate, age 60, and I look at that rate, we put $100,000, the same amount in again, and we're looking at 52.38. And remember, our male got 56, so he actually got more. But because of her life expectancy, her actual numbers are north of 130 accum based on her standard tables and dying at age 85. So if I'm looking at what is the expectation, should I be doing a joint survivor on this? Should I be doing it? I don't know. I have to do the math. Right now, even though the female is about $300 less a year in my total payout, I'm going to have to look at, see, is that the better deal? Because I'm expecting her to live to be about 85. Now, if I go ahead and do some more here, I do an age 70 female, same money, I'm going to look down and say, okay, now my female rate is 65.40. And because I'm thinking that she's going to still live at that expectation of 85, she's going to have about 111,000 plus north of that number based on the 2001 CSO, or the way I'm looking at it right now, maybe in the VBT standard tables. If I have a female age 80 with the same $100,000 drop, I'm going to be looking now at 92. Now remember, the male was 10,400, but at her number at 9204, I'm looking at somewhere around 92,000 plus at her number. So she's not recovering basis. So at her life expectancy, I'm going to question whether we should do this and maybe even that. So I want to be able to get some map. Now let's look at a preferred rate, because I think that'll also give you a kind of an idea of what we're talking about. If I go back to my platform, female 60, and she's preferred, those numbers now change a little bit. She's still at the $100,000 deposit, and she's 52.38 like she was before, but because we have her living to 94 at the preferred tables, now we're looking at a number north of 178,000 in accumulation. That's 178, not 128. If I use a female at age 70, another 10 years with the same deposit, now I'm looking at a payout, again, the same payout, 65.40, but again, I'm pushing her out to age 94. Now I'm looking at 156,000 plus, and again, that's 178 on the top one. And then when I look at the top 80 years old female with the same deposit, I'm looking at 9204. Now remember, last time we didn't get to basis, but this time we do because we think she's going to live longer. It's 128,852. Now the reason I bring this up is because, again, I'm looking at timeline theology here. The longer the timeline, the more recovery, the preferred the client is. I'm looking at timelines like this. And I always want to be able to measure, is this a good deal? Is this a bad deal? I won't really know, not based on the interest rates today because the environment is so low. I have to look at the mortality credits that are assigned to these genders, their age, and what our life expectancy is, so I can determine, is this a good deal or not? Now remember, in SPIA life-only scenarios like we're doing here, male and female, if you died the next day, you wouldn't have any money because they guarantee it for life, but if your life's only 30 days and you died, then that's it. Some people use, and a lot of people like cash refunds, and those cash refunds can help you get at least what you got into it, and they can give that back in a lump sum, sometimes in an installment. It just depends upon what you're trying to get done. And remember, I have to also look at, depending upon the spread in ages, sometimes I'll look at joint life, putting male and female on those rates to see what kind of numbers I get. And also I want to look at, can I put a cost of living rider on this to pick up inflation? It's really interesting to look at the math to see what you think. Probably, what in my view is, the longer the timeline, the more preferred the client is, the more expectation that they're going to live into their 90s, possibly even 100s. I'm going to start looking at maybe the cost of it, the cost of living riders, see what that cost is inside the actual annuity, and price it out and see if it's worth doing. Those are some of the basic issues. Now what I want to do is I just want to show you on another chart some basic information using 10 certain, 20 certain, and 20 in life. In our whiteboard examples, remember we're using age 60, 70, and 80 at SPIAs, both male and female. But here, we're using a male, 65, $100,000 deposit, and I'm asked for a 10-year certain pay. And I'd like to know what that number is. And it shows the monthly income by several carriers. So I've taken a kind of like a top 10 view of how many carriers. And it's interesting to note that between the lowest number and the highest number, there's really not that much difference, because most of these carriers are fishing out of the same United States debenture pool or debt pool to be able to generate these numbers. And so even when you see a league leading like this, the first carrier is $907 a month, just remember the lowest one's $848. So the spread is $50 a month. Keep in mind that because we're doing a 10-year certain, once it's over, it's over. And generally your beneficiaries are going to receive the difference if you die as the annuitant. So that's very important to make sure the language of the annuity contract is really good. The other thing I want to point out is the monthly taxable portion. So out of that 902, only $74 really is going to be used upon as the taxable portion, or the gain. So we're getting some of our basis back in a low interest rate environment. I don't know if this is the way to go. It's just too short a timeline. But let's look at the 20-year rate and see if that works better. Now we're looking at 20-year certain, and there's been a little bit of rearrangement by the carriers because some carriers feel a little bit stronger about longer timelines. But again, look at the low number, 20-year off 100,000, male 65, and I'm just looking at the lowest number, which is $497 a month for 20 years versus $544 for the same period in time. So again, the spread between carriers in these 10 carriers we looked at is really very marginal. Again, the taxable event, you have to look at the monthly taxable income. Here's where the play could be. Notice that certain carriers, depending upon how they price it and when they guarantee it, you're going to see different fluctuations in the way they price their monthly taxable portion. You may have to actually do some math here to see, is number one at 544 with 128 exposed to taxes, is that better than 497 with $81 exposed to taxes? You got to do the actual net return. It depends upon when you're receiving it. That's why they use different guaranteed periods. You got to map it all out and make sure you're looking at the same thing equal time, especially at the guaranteed period, so that you can match up your taxable portion and your monthly benefit to make sure, is that really a good deal? Again, this is low interest rate environment. A lot of people are shying away from long-term commitments like 20-year certain, but if this is something that you're looking for and you're looking for just a good preservation of principal, low interest rate, a little bit better than the banks, this could be the way to go. But I think it's too long. And so some people are saying, yeah, that's too long to lock down rates. We're hoping that we're at the floor and that sooner or later interest rates are going to start to tee up, and that'll make it better. Now let me show you one more. Now this is 20 years and life, so I'm at least going to get guaranteed 20 pay no matter what happens here. I want to see that rate, but 20-year and life, those numbers now have dropped. Again, the difference between first place and third place is about $35 to $40. So I want to recommend that when you look at life, do you need a 20-year guaranteed certain involved with your life, or a 10-year certain? You need to price it all out. Some illustrations, proposal systems actually give you the entire map. So I like it where it's 10-year certain, 20-year certain, 10 in life, 20 in life. All those are measuring lifetime income based on what, or time certain, by the client's mortality.
This has been an Edutrainment Workshop, the educational division of the National Insurance Clearinghouse.